Hey guys, what is up? It's Arthur here, and in this video we're going to take a look at Supermicro Computer, ticker symbol SMCI, as one of you guys in a previous video in the comments requested that we have a look at this company, so we'll see what we can add to the discussion. Before we dive right into that, I want to mention that I have a new website. Link is in the description. There are materials and links to articles and other references where you can learn more about specific topics. And I also have a new course coming out soon that will teach you everything from A to Z. So drop your email in the email subscription box if you're interested. You will not want to miss that. Others who watched previous videos know why, but just trust me on that. So diving into Supermicro Computer, Supermicro Computer engages in the distribution and manufacture of information technology solutions and other computer products. It just goes on to list what that is: AMD solutions, power supplies, super server, storage motherboards, so accessories, workstations. So I guess they're just supplying companies with data centers and just, not PCs, but bigger things than PCs. I'm not sure supercomputers. You would have to look at their own website and see what they really deal with. This is just a bird's eye view that we're going to take a look at this company. But we know that large companies are investing in these systems because if they have their own AI model or some kind of agent, they want the computational capacity to run that, especially if they are a software as a service company and offer that for other companies where all the computation is happening at their place, at that company's place, so they would need that capacity. So that's where SMCI, Supermicro Computer, could come in. If that's one of their things, you gotta look at that. But we have this nice list, 10 items that we're gonna go through and see how Supermicro Computer does on this list. Quickly take a look at the dashboard. It's roughly a $30 billion company, as you can see, also on the top right corner of the screen. Enterprise value is very similar, which is calculated as adding the debt and deducting the cash, which means that there should be roughly enough cash to cover the liabilities. We're going to take a look at that. Gross profit margin is actually down in the trailing 12 months, in the past 12 months. And then profit margin is also down roughly 1 percentage points. That's 1%. Yeah, I think you can say percentage point. So it went from 6.6% to 5.6%. That's the best way to put it. This is not good. There is no dividend, so we don't have to account for that. Augmented payout ratio is negative. That probably means they are issuing shares. There's some company purchases. Free cash flow is going to be negative, so that's not really good. But stocks trending upwards, it seems like. So let's see what we can find. First things first, we want to see revenue going up as our first indicator. You're going to go into the financials. I'm using MarketWatch. This is what my spreadsheet is set up for. Income statement, first line, all the money that comes in, sales revenue. It is up from 3.3 billion to almost 15 billion. This is a massive increase, about a 4.5x, so roughly 350% increase. This is very, very nice to see. It's not a linear trend, it's more like an exponential if you look at this tiny graph here. So this is a bit harder to predict into the future, but let's see what we can make out of this. Next item, we want to look at the net income. So once you know all the money that comes into the business, you're going to work your way down all the expenses and arrive at net income, which is also up from a little $84 million all the way to 1.15 billion. Similar exponential trend. So that's another check mark. This is up a whole lot more. Either because this was a very small number and small numbers are easier to grow into big numbers, so the percentage looks better, or somehow we had some operational efficiency increases so you could retain more of your earnings in net income, but that roughly looks proportional. So Yes, if you look at here, it was 3.5 both years, but this was smaller than that, so probably it's just a very small number to begin with. But you can feel free to look through the numbers and try to see where the money is going. Right, so now that you have your net income, you can calculate the average of that, which is here on the card, top right corner, roughly $454 million. What you can do with this number, this is what on average in a year the company takes home on paper, right? And then you can do stuff with that. But what you want to do is you can get the market cap, 30.9 billion, as you can also see on the top right corner, and you can divide that number by the average net income. That's going to give you a number which tells you how many years it would take for the company to earn back the money that you used to buy the company or your share. It's easier to talk in terms of company because that's what you are doing here. You're becoming an investor, a business owner. So it's not just about buying ticker symbols and shares. Think about it as buying the whole company. It's gonna lead to better investment decisions. So if you do that and divide that, you can get 68.02, which is a massive X. You would want this number to be below 20 for the share or the company to be considered not expensive. Now there's a caveat. The caveat is with companies that have future growth potential, you are okay paying a higher multiple because as you go forward in the years, the earnings are likely to increase. And once it starts increasing, it's going to decrease these numbers, right? So this 68 years in price to earnings means that if average net income stays $454 million going forward, but if you think there is growth potential, it's going to increase, and a higher number here is going to decrease the result that you get by this division that you made. So if, I don't know, the average would be 900 million a year that they could achieve, then all of a sudden your P ratio would be 34, right? So that's how it works. But to put that into perspective, a new thing that I like to do is we look at the industry that this company competes in and see how expensive or how that industry is priced. For that, I usually use TradingView. You have the individual company profile, and on top you have these breadcrumbs. You go to the most precise division, which is computer processing hardware in this case. Click that. You have some competitors. You also have a PE column. I take that column, arrange them in increasing order, and just take the middle one. That's the median, and I call that the sort of the valuation of the industry. So I can now see how SMCI compares to the middle. And in that case, you get that it's still more expensive than what the industry would say, because this is over the 21 that the industry says. That's another X, unfortunately. But you also want to take a look at, which is our fifth card, how well they spend the money that gets put into this business. This is called return on invested capital. So $1 that gets put into this business through equity or debt, what return are they able to make on that? Market average is around 9 to 10%. And this is a sort of it's not necessarily a more complicated formula, but it is not standardized. So different websites, different analysts will have different values. Mine comes out to 10.78%, which is above the market average, and that's a check mark. You can also find that here on MarketWatch. It's going to be in profile. It could be a wildly different number. It's 24% in their calculation. It's also above market average. Just know that this is gonna be different however many sites you look at. But if you take a look at a lot of them and see the general trend, you can probably have a better informed guess of where it would fall compared to the market average. Right, we talked about making money and taking home money on paper as net income. What we're gonna be very interested next is how many ways we have to share it with other owners. That is when we look at the shares outstanding, which is our next card, and probably one of my favorites. It's going to be in your income statement. You work your way down to the amount of money that you take home on paper, and then you have shares outstanding, basically how many shareholders are there and how many ways you have to, not how many shareholders, but how many shares are there, because one person can hold more shares, and how many ways you have to distribute your earnings. You would want this number going down, which is unfortunately not the case here, because we are up from 528 million all the way up to 602 million, which is about a 14% increase over the past 5 years. This is not good to see because you are getting diluted as an owner. So if you buy this company, do nothing, in 5 years time, your stake in the business is going to be worth 14% less. Now, there's another thing. You would want, one thing is that you want the opposite of this happening, where share prices would go down over the years, meaning that without doing anything, the company's buying back the shares, making you bigger and bigger owner of the business, because there are just less slices of this pizza to go around, and you keep your purchase number of shares while the rest of the supply gets smaller. That's one thing. The second thing is that companies might start issuing shares when they think the company is overvalued. And the reason for that is when they issue new shares, if the company is overvalued, according to them, in some cases, those new people buying the shares, getting in as new owners, would overpay for the shares that they are buying. So the company in the end makes more money and raises more capital, but you are getting diluted as an owner nonetheless. So this is not good to see. You would want to look at whether they have share repurchase programs planned, or if they are just planning to issue more shares, because I would be cautious with this, because this is just deteriorating your position in the company. All right, next up, we're going to take a look at what growth their liabilities, their debt, has grown over the past 5 years, and compare it to the revenue increase they managed to gather in the past 5 years, which we already calculated in the first card at 348.8%. The way you do that is you go to the balance sheet, which is a snapshot in every year of the company's, what they own and how they can afford it. That's the easy way to put it. You're going to go to liabilities, and the trick is you don't have total long-term liabilities. You have total current liabilities and you have total liabilities. Now, how you get total long-term liabilities? Very simple. Current liabilities is for all the debt that is within 1 year, not just debt, but like liabilities that are within 1 year. Long-term is not within 1 year. So what you do is you take total liabilities, you take this number and you deduct total current liabilities for the corresponding year. And once you do that, you are left with like 2.07 billions of total long-term liabilities for the year 2024. You can do that for all 5 years, and then you can see the increase or decrease and then calculate the percentage from that. If you do that, you're going to see that liabilities, total long-term liabilities, are up 1,250%. So that's massive, which is an X, because liabilities grew quicker than the money they managed to make. Now you have to understand this is not a one-to-one comparison, but just to give you an idea, because it might happen that this company is investing in a new facility, in a new production facility or distribution center, something along those lines, for which they need to have debt on board, they need to have more liabilities, and it might take more years, 5-10 years in the future, for it to start making that revenue. So it balances things out. I'm not saying this is the case. You would have to look at that, where that long-term liabilities came from and what's the plan with that. One very good way, probably the best way to look at, is annual reports from the company, or investor relations, news reports, meetings, and also the 10K that they issue, which is a 100-page document that you can probably find everything in that you would be interested about. Now, what we can also check, since we have about $2.07 billion of long-term liabilities, whether they can afford that. We saw free cash was going to be negative, so they are not going to use that to pay down that debt. But there might be something that we can take a look at that. So we can see total current assets. These are things that are very quickly convertible to cash, and they have $9 billion. Not all of them will be converted to cash, but in case of need, they can do that to sort of work out the liabilities question. So this is a bit reassuring. A lot of that is in inventories, of course, probably the components for the data centers and PCs and whatnot. They have cash, 1.67 billion, compared to the 2.07 billion of total long-term liabilities. So that is not that bad of a situation. They also have money coming in. The other side, they probably also have to pay out some of that, but it's not looking terrible. Long-term liabilities grew a lot, but they seem to have some cash to, cushion the situation. Next up, I want to look at the free cash flow growth, which hasn't been good, but if you go to cash flow, the way you calculate it is you take net operating cash flow and you add the negative number of capital expenditures. So let's say this year, you would take 663 plus the minus 36, plus minus is minus, so this would be 30 million ish. You do that for all years. If your chosen website does not have that, MarketWatch does offer that. If you scroll down, there's free cash flow, and this is all over the place. Now these years, slightly okay. I think this is net negative, and then this is a huge negative. So you would want to understand why that happened, because you use free cash flow to buy other businesses, reinvest in the business, buy back shares, issue dividends, and pay down debt. And if you have negative free cash flow, that's not really is viable going forward, because you're just bleeding money. This might happen for new startups where they are kept afloat by injecting more and more money into this. But as we saw, I think in the profile, this company has been around for 1993. Yes. So that is minus. That's an X, because free cash flow is not growing, it's decreasing. It's a bit of a roller coaster with a big dive at the end. So you would want to look into that. What's the plan with that? And what I usually do is you can take this average free cash flow number, so you roughly know how much money, cold hard cash, the company has at the end of each year, in case it's a negative average. But you could take that and divide the long-term liabilities, the 2.07 billion, with that number to see how many years it would take for them to pay off. Now this is a negative number here because your free cash flow is negative, so you cannot make sense of this. But as we looked at, they have some cash to cushion the situation, but I would be cautious. Just by looking at this, you would have to dig deeper and see what their plan is. Last item on the checklist, you would also take the free cash flow number, and as you did with the PE ratio, you would go and grab the market cap, divide this by the free cash flow number, and you also get the number of years it would take for the company to recoup your investment in free cash flow, which you also cannot make sense of this, so it's an X because you have negative free cash flows. So SMCI ends up with a 3 out of 10. Revenue growth and net income growth has been fantastic. The company is expensive, probably because of the growth, 3 times more expensive than the industry would indicate. They are earning a respectable, good return. It's not fantastic. The biggest companies are around 30-40%, which is massive. 10.78% is good, nice to see. They are issuing more shares That situation seems manageable if you figure out what happened with the last year 2024's free cash flow situation and why that is. Other than that, that's from where you can move forward into analyzing this business. But those would be the things that I would look at first. And I don't think we can do a discounted cash flow analysis on this because free cash flow is negative, so that's not really viable. So I would skip that. And yeah, I hope this was worth your time. Let me know of your thoughts. Also, let me know what company we should analyze next, or which two we should compare. That should also be interesting. Don't forget to subscribe. We are close to hitting 500 subscribers, which would be huge. And again, thank you for your time, and I hope to see you in another video. Thanks. Bye-bye.